Now, let's try to see the textbook definition or textbook concept for revenue recognition. So, textbook simply says that revenue is recognized when a company or an entity satisfies a performance obligation by transferring control of goods and services. So, basically, when goods and services are being transferred to a customer, and the amount of revenue recorded should reflect the consideration the entity expects to be entitled to in exchange for goods and services. So, whatever consideration will be there, just like if you buy an iPhone and only iPhone is there and they are charging $1,000 and the company is expecting that they are going to receive $1,000, so they will recognize that as a revenue. Now, this revenue recognition standard AS 606 that applies to all kind of entities, whether the entity is public or private or not for profit, and that entity enters into a contract with the customer to transfer goods or services or any other non-financial assets unless the transaction is governed by any other specific standard. So, if any other standard is governing revenue recognition method, which may happen in case of banking and insurance. So, in that case, different standard may govern them. However, this is the basic definition or textbook definition of revenue recognition.